Hey there, and welcome. In the world of business, companies get bought and sold literally every single day. But have you ever stopped to wonder what actually determines their price? Well, in this explainer, we're going to pull back the curtain on the art and science of financial valuation and figure out just how analysts put a price tag on a whole business.
Okay, so let's just dive right in with the biggest question of all. When you hear that some company is worth billions of dollars, where in the world does that number even come from? I'll tell you one thing, it's not just about what the company owns right now.
And that's really the key. The whole game of valuation is about looking forward. The most trusted methods, they're not based on what a company did in the past, but on its power to generate cold, hard cash in the future. We're basically trying to figure out the value, today, of all the money a business is going to make for the rest of its life.
Now, before we can even start to put a price on anything, we've got to be crystal clear about what exactly we're valuing. Are we talking about the entire company, lock, stock, and barrel, or just the piece that belongs to the shareholders? It's time to slice that pie.
Here's a super simple way to think about it. Imagine a house. The firm value, that's the total price the house is worth on the market. But the equity value, that's the cash you get to keep after you've paid off the bank's mortgage. See the difference? One's the value of the entire thing, the other is what's left over for the actual owners once all the debts are taken care of. And this is the simple math behind it. You start with the total value of the firm, everything it's got. You subtract what it owes to its lenders, that's its debt. And what's left over, that's the equity. That's the piece that truly belongs to the owners. Getting this right is absolutely the foundation for everything that's coming next.
All right, so if value is all about the future, we're going to need some kind of crystal ball. Well, in finance, that crystal ball has a name. It's called discounted cash flow, or DCF. It is hands down the most popular valuation method out there. And as we're about to see, it all boils down to two essential ingredients.
At its heart, DCF is built on one simple but incredibly powerful idea. A dollar you get a year from now is worth less than a dollar in your pocket today. And why is that? Well, because of risk, and because you could invest that dollar today and earn a return on it. DCF models just take that logic and apply it to all the cash a company is expected to produce way, way out into the future.
So here they are, the two key ingredients for our financial crystal ball. First, we've got to actually predict the cash the business is going to generate. Second, we need to pick a discount rate that accurately reflects just how risky those future predictions are. Let's break them both down.
Let's use an analogy here. Imagine a company's revenue as a big flowing river of money. To figure out free cash flow, that's what we see on the left, we look at how much water is left after we pay for all the operating costs. That remaining stream is what's available to everybody who put money into the company. But to find the flow to equity, on the right, we have to open another little gate to pay off the debt holders. What finally makes it to the end of the river, that's the cash that belongs purely to the shareholders.
Now, getting to this true cash number, well, it's not as simple as just looking at profit. We have to make some really important adjustments. We have to add back expenses that aren't actually cash leaving the building, like amortization. We also have to account for changes in working capital, money that's tied up in inventory. And, of course, we subtract the cash the company spends on new investments. It really is a bit of financial detective work to follow the money.
Okay, so we've got our cash flow forecast. Awesome! Now for that second ingredient, the discount rate. This is how we deal with the simple fact that the future is uncertain. The riskier the company, the higher we set the discount rate, which means its future earnings are worth less in today's money.
To put it simply, the discount rate is just the minimum return that both lenders and shareholders demand for putting their money into the business. Lenders have their required return, that's the interest rate. And shareholders, well, they have their own required return, which is usually higher, because, let's face it, their investment is a lot riskier.
And this brings us to a really important metric called WACC, or the weighted average cost of capital. Now, don't get hung up on the formula for now. The big idea is that it just blends the cost of borrowing money from lenders with the return demanded by shareholders, and it cooks it all down into one single powerful discount rate. It's basically the average price the company pays for all of its funding. So now we have our two ingredients, right? Cash flow and a discount rate. You might think we're all done, but here's the twist. The best way to put them together actually depends on the company's strategy, especially its plans for using debt.
All right, you're going to want to pay attention to this slide. It's basically your valuation cheat sheet. The big difference between all these methods really comes down to one thing: how they handle the tax benefits you get from having debt, something we call the tax shield. So for a really stable, predictable company, say a utility,
Where the debt level is pretty much constant, WAC is your go-to method. It's perfect. But what about a tech company in the middle of a huge restructuring, where debt is just all over the map? Well, for that, you need a much more flexible tool, and that's where something like APV comes.
So what is this all-important tax shield anyway? It's one of the biggest advantages of using debt to finance a company. Because the interest you pay on debt is tax-deductible, it shields some of the company's profits from being taxed. That tax saving is real cash, and it adds real value to the company. And how we account for that value is what really separates all these different models. So let's take a closer look at that APV method, the one that's perfect for companies with changing debt. The logic behind it is actually really elegant. First, you value the company as if it had zero debt, just the pure raw value of its operations. Then, in a completely separate step, you calculate and add back the value that's created by its financing, like that tax shield. It's a clean, two-step process that gives you incredible flexibility.
We've covered a ton of ground here, right? From cash flows to discount rates to all these different models. But it is so important to remember that valuation is never just about plugging numbers into a formula. At the end of the day, the final number you get is massively dependent on the assumptions you make at the very beginning.
This diagram really brings the whole WAC process together. It shows how everything flows directly from our assumptions about what the future holds. Those assumptions drive our cash flow forecasts. Then we apply our discount rate to get the firm's total value, we subtract the debt to find the equity value, and finally, we can land on a price per share. It's a whole journey, from a story about the future all the way down to a single number.
And this right here gets to the absolute heart of it all. The value of a company can be completely different for different buyers. Think about it. The strategic buyer who can create what we call synergies, like major cost savings or brand new revenue streams, they're going to see a much, much higher value in a company than a simple financial investor would. Value is truly in the eye of the beholder.
So, I'll leave you with this to chew on. The next time you see a headline about some massive corporate takeover, I want you to think beyond just the price tag. What kind of future are they buying into? What hidden value are they hoping to unlock? Because, as we've seen today, the real value isn't just about what a company is, it's about what it can become.